The new long-term inflation and interest rate cycle is here, which means that both inflation and rates are moving higher for much longer. We recently got a taste of this as the yields on the 30-year US Treasuries surged higher, breaking out to levels they haven't been at since 2011. We're seeing similar moves across the entire yield curve, with the 10-year breaking out to levels it hasn't been since 2011. And while we are seeing rates inch higher for the 2-year, when you look at the short end of the curve, like at 1 year, 6 months, or shorter than that, we are not seeing a similar spike. Essentially, we are seeing a flattening, a re-steepening, an uninverting of the yield curve. And it's being led by the long end surging higher, which historically is extremely abnormal. Typically what happens is the yield curve will invert, which is the market expecting a recession and expecting the Fed to intervene by pushing short-term interest rates down. But the Federal Reserve has been very clear, and Powell in his most recent press conference even said, we are not expecting a soft landing. In fact, when a reporter asked him about his base case being a soft landing, he interrupted the reporter to say, no, a soft landing is not our base case.
Would you call the soft landing now a baseline?
No.
And yet the Fed is still sticking to higher rates for longer. The market is now not anticipating any rate cuts next year, which it used to be anticipating many rate cuts next year. If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I teach active investors how to get higher returns while limiting their risk. Interested in learning more? Link is in the description below. Now, if the Federal Reserve is not forecasting pushing short-term interest rates down in order to deal with a recession, they're just saying, we're gonna keep things tight regardless of what breaks, then yeah, the only way for the yield curve to uninvert would be for the long end to rise. But you may still be looking at short-term yields and thinking, well, why are they so flat? This is a result of the cash that is currently in the reverse repo facility at the Fed. Currently, $1.4 trillion is sitting in this repo facility, and it's getting paid 5.3% risk-free by the money printer at the Fed, which is why the government has to pay a tad bit more than that, currently 5.5%, if it wants to borrow short-term money. Because while treasuries are considered risk-free, really you still do have some element of risk. What if there's political gridlock and the payments can't be made? Whereas any money that's in the reverse repo facility is actually risk-free. This is paid literally by the money printer. Now, the reason why it's paying 5.3% right now is precisely in order to put a floor underneath short-term interest rates. The Fed wants interest rates high right now. They're trying to fight inflation. But first, a word from today's sponsor, Silver Bullion in Singapore. They have a revolutionary peer-to-peer bullion secured loan program. This enables you to put your precious metals to work by taking out a loan against your gold or silver. Now, because your loan is collateralized by your metal, you get some crazy advantages. Essentially, you get to set your own terms for the loan. First, you get to choose the amount you want to borrow. You can choose which currency you'd like to take the loan out in, like Singapore dollars or the euro or US dollars. You can choose your loan duration, anywhere from 1 month to 2 years. And you can even choose the interest rate that you want to borrow at. Now, the best part is that as a borrower, at no time do you lose any of the full legal ownership of your precious metals. This peer-to-peer secured loan program comes along with many other benefits of storing metal in their Star Storage program. Again, you have full legal ownership always. The vault tests your metals to make sure that they know exactly what is there and where it is. The jurisdiction in Singapore, which is one of my favorite benefits, considering Singapore is my favorite country on earth to store precious metals in, because they have the highest degree of economic freedom of any nation on earth. They also have industry-leading insurance on top of what is required for things even like mysterious disappearance coverage. Now, there's obviously a lot more to this, so I highly recommend clicking on the link in the description below, filling out the form so you can contact their team to learn more about this amazing program. Link is in the description. And so if the government tried to borrow short-term money at, let's say, 5%, they wouldn't be able to because you could get 5.3% completely risk-free from the Fed. But the funny thing about this facility is that while it does operate as keeping a floor underneath short-term rates, it's also acting as a soft lid on short-term rates as well. Because imagine hypothetically the yield on the 6-month shot up to 6%. Well, that's a heck of a lot better than 5.3%, which means that a good chunk of the $1.4 trillion that's currently earning 5.3% would leave the reverse repo facility and go buy up that debt at 6%, which would then push it back down to its current rate of about 5.5%. And this is actually precisely the mechanism that has been causing the reverse repo facility to drain over the last year. If you'll notice back in April, just 5 months ago, the reverse repo facility had over $2.3 trillion in it. And over the course of less than 5 months, that amount has drained to 1.4 trillion. Essentially, as the government borrows more and more, they have to pay a higher and higher interest rate, and that attracts more and more money out of this facility. That demand for short-term government debt continues to keep short-term rates suppressed. But this is just happening at the short end of the curve. The reverse repo facility is for short-term cash needs. This is an overnight facility. So it's where money like the dollars that you put into your money market fund in your brokerage account end up. This means that money is not available to go into long-term debt like the 30-year treasury, which is why we're seeing such a surge in yields recently. And government borrowing is just getting started. We've seen $1 trillion in new debt just in the last 90 days. But that's nothing compared to what's coming over the next 2 years. This chart breaks down the maturity of government debt, and this large blue line for the USA that reaches almost up to 45% is debt that matures in under 2 years. And that was as of January of 2023, which means in the next year and a half, the government is going to have to refinance almost $16 trillion worth of its debt. With the national debt currently over $33 trillion, having half of that come due in the next year and a half is a big deal, especially considering most of that debt was accumulated at much lower interest rates. Basically, what the government is doing here is refinancing their debt at a higher interest rate. So think about this from the perspective of your mortgage. If you have a 2.5% or a 3% mortgage, would it be a wise financial decision for you right now to refinance that mortgage at a new 7% interest rate? Absolutely not. But that's exactly what the government is doing here, not by choice, but because they're being forced to. Forced by the consequences of their own financial irresponsibility. Now, one objection to this problem of the national debt that I keep hearing lately a lot of is that it doesn't actually matter. The national debt is our national asset. It's a collective asset, and it's just money we owe to ourselves. Heck, the more debt, the merrier then, right? Well, guess what? There is no such thing as we. There are only individuals. There's no such thing as the economy. There's no such thing as society. There's no such thing as a separate entity that is a nation or a government. There are only individuals that take action in certain ways, which means that this $33 trillion pile of national debt that is skyrocketing and growing very quickly is money that is borrowed from some individuals, and that money is then spent to other individuals. And then that debt is repaid by taking money from other individuals. Very simply put, the national debt matters because it's a transfer of wealth from some individuals to others. And so when you hear people proclaiming that the national debt doesn't matter because it's just money we owe to ourselves, I would be willing to bet that they are on the receiving side of that wealth transfer, and they just don't want you to think about it. And as if that wasn't enough of a problem, this is not just affecting the government's balance sheet. It's affecting the cost of all debt. Case in point, mortgage rates, currently at over 7%, are at their highest they've been since 2001. Keep in mind, the median sale price of a home at that same time was only $171,000. compared to today's $416,000. It's also pushed interest rates on credit cards above 20%, a level that they haven't seen in decades. It has also pushed the delinquency rate as a result up on credit cards to 2.77, which is the highest it's been since 2012. The Federal Reserve has been very clear. They are not going to stop tightening and lower rates just because of economic pain. In fact, it is their express purpose right now to trigger and cause economic pain. Do not expect the 2020 money printer to come back. Do not expect that free money train. It's not going to happen. The Federal Reserve is far too afraid to reignite inflation and pivot too early. The only thing that will cause the Federal Reserve to reverse course is when this number, the amount of dollars the US government has to spend, is so large that they are not able to afford the interest on the new borrowing in order to do so. A sovereign debt crisis on one side or hyperinflation on the other side are the two extremes and the only things that threaten the global hegemony of the dollar. And at this point, it seems like those two extremes are the only things that will cause the Fed to change its actions, which means we have entered into the beginning of a new long-term debt cycle. From 1940 through 1980, interest rates and inflation both moved higher. After peaking in 1981, we entered a new long-term debt and inflation cycle where interest rates and inflation both moved lower for, again, 40 years until they bottomed in 2020. We have turned the corner and have begun a new long-term cycle that is again the opposite of the one we were in before, with interest rates and inflation both moving higher for longer. During these long-term cycles, there are short-term time periods in which the move is against the longer-term trend. So when rates are going up, there are periods of time when rates come down. And when inflation is moving lower, there are short-term periods of time when it moves higher. But overall, in the coming decades, we are going to experience higher prices and higher rates because the only way to avoid a sovereign debt crisis is to print the money, which means that the debt gets defaulted on, technically speaking, through inflation. And that inflation hits the economy. And because of the long-term inflation expectations, as a result of the unfunded deficits that have to be printed to pay for, interest rates for everybody else will move higher and higher and higher. The future is absolutely unknowable and nobody has a crystal ball, but one of the biggest mistakes that investors make is assuming that the future years will be similar or identical to the years that just happened. This is something called recency bias, and it ignores what can take place over a much longer time scale of multiple decades. And of course, I would love it if you would join me and all the members of Heresy Financial University who are profiting off of this. There's no sense in just complaining and saying things should be a different way. We can also take a look at the current environment, construct our portfolios in a way that allows us to make money and not be exposed to crazy crashes, inflation risks, deflation risks, but to grow and protect our wealth. The best source of financial education you'll find linked in the description below. As always, thanks so much for watching. Have a great day.